Welcome, everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back, everyone. Let's kick off this episode with a little swan watching, starting with a tweet from the Spectator Index. Kremlin drone attack. Russia says 2 Ukrainian drones attack Kremlin overnight. Drones down with no victims or material damage to the Kremlin. Moscow says it was a terrorist attack and an attempt on Putin's life. Russia says it reserves right to respond when and how it sees fit. Then over at Zero Hedge, another headline. Former CIA officer says decision to drone attack Kremlin was made by the United States. Former CIA intelligence officer Larry Johnson says the decision to launch a drone attack on the Kremlin was made by the U.S. The Wednesday attack, which was likely to have been targeting Russian President Vladimir Putin, was stopped by electronic warfare systems, which disabled the drones before they could reach their target. According to Johnson, the attack must have been spearheaded by the Biden administration and the U.S. military-industrial complex because, quote, decisions on such attacks are not made in Kiev but in Washington. Washington should understand clearly that we know this, Johnson had told reporters. Although the attack, which Ukraine denied it was involved in, failed to accomplish its tactical goal, it's still highly symbolic, according to Larry Johnson. Guys, Uncle Frank's looking for a black swan, not an atomic swan. And before I dive into all the AMC material I have for you, how about some good news? A recent report by a leading research firm has ranked Ripple as the #1 company for central bank digital currencies, or CBDCs, ahead of established players like MasterCard and Visa. The report, which was published by Juniper Research, evaluated the leading players in the CBD space, assessing factors such as technology capabilities, partnerships, and market reach. After analyzing the data, the report ranked Ripple as the top company for CBDCs, citing its blockchain technology as a key factor in its success. Take that, Crypto Kyle. Now, for you Mullen and AMC Ape conversion reverse split fans, Mullen Automotive did conduct a 1-for-25 reverse split on Thursday and a CUSIP change, but we really didn't see the reaction in the stock many had hoped for. Announcement from MarketWatch. Mullen Automotive shares plunge on reverse stock split announcement. However, on Friday, Mullen did manage to close at $1.50, up 2.04%, and then in the after-hours session, it rose another 7 cents, up 4.67. The reason I bring it up is based on that last price of $1.50, your first resistance point to the upside is $1.5467, and we've already traded through that after hours on Friday. So be looking for other resistance points at $1.59 and $1.65 on Monday. As it turns out, Mullen is now a meme stock. Mullen Automotive, now a go-to meme stock, says influential trader. From the article, Mullen Automotive is attracting more meme-like attention from retail investors than traditional meme stock darlings AMC Entertainment Holdings and GameStop, according to an influential meme stock trader. And I guess it is a meme stock because it's already getting hit pieces. Mullen stock alert. The Mullen Army is betting on the next meme stock. Even an army can't save shares of Mullen Automotive. One market influencer says retail interest in Mullen Automotive stock is surging. They predict that MULN stock army is developing, similar to the apes behind AMC Entertainment. However, Mullen stock still doesn't have much chance of rising, even on meme stock momentum. Despite the drop in stock price for Mullen Automotive, which many blame on short selling and on the reverse split, Mullen has actually had a lot of good news recently. 19 EV cargo vans have been delivered to date, with 20 additional deliveries targeted for May. A 1,000-unit purchase order valued at $63 million for the Class 3 EV trucks from Randy Marion Automotive Group was announced on May 2nd, with deliveries beginning in August and final deliveries completed by the first quarter of 2024. Also, starting on May 1st, UNC Charlotte will begin taking delivery of an additional 8 Mullen EV cargo vans. This is the second vehicle order for UNC Charlotte. Now, guys, I can't tell you to buy, sell, or hold any security or cryptocurrency. I am a Mullen shareholder. I think it's an attractive price. It is a very high-risk stock. However, let's acknowledge it's very difficult to start an automotive manufacturing company in the United States against the big three and Tesla. It requires a huge amount of money. This company was founded like 20 years ago. They're finally making their first sales. But I would like to tell you that I find this UNC Charlotte release very interesting, and I'll tell you why. If it was a bad product, would there be a second order? Think about it. Now, before we dissect the AMC earnings call, let's take a look at our competitor Cinemark. Why is this important, Uncle Frank? I'll tell you. This flies right in the face of the predatory short hedge funds and the pundits in the media that are constantly saying the theaters are dead, streaming is the future, they'll never recover. A headline from The Wrap: Cinemark blows past Wall Street forecast with $611 million in Q1 revenue. From the article, Cinemark posted a dramatically smaller loss for the first quarter, besting analysts' expectations as the national theater chain saw customers return to the movies in droves. The Plano, Texas-based company said revenue leaped 32% to $610 million for the 3 months ended March 31st, compared with $460 million for the 2022 first quarter. Analyst poll by Zacks Investment Services had on average expected revenue of $569 million, and the actual figure exceeded even the highest estimate tracked by that service. You see, guys, even the analysts are always handicapping the theater and movie business. To continue, the company noted that the volume of wide-release theatrical films in the quarter increased by more than 25% over the 2022 period. Full-year volume is tracking better than expected, with 110 wide-release films on the docket. Admissions revenue soared 32% to $311 million, including $244 million in the U.S., up 27.5% from last year. Concession revenue leaped 36% to $235 million, including $186 million in the U.S., up 32% again from last year. Now, here's what's interesting. In pre-market trading, shares jumped 6% after closing Thursday at $16.51, up 88% since the start of the year. AMC over the past year is down 39%. Over the past 3 months, down over 3%. You see the difference? Now, AMC had similar positive results, which is good to help defeat that negative narrative. Adam Aron is quoted as saying, "Our results for the first quarter of 2023 represents AMC's strongest first quarter in 4 full years. We kicked off 2023 by continuing on our positive glide path to recovery with more than a 21% growth in total revenues and a $69 million improvement in adjusted EBITDA compared to the previous year. And Adam is right. Total revenues grew by 21.5% to $954.4 million. Our net loss improved by $101.9 million to settle at $235.5 million. Adjusted net loss was $179.7 million compared to an adjusted net loss of $266.3 million. Everything heading in the right direction. Diluted loss per share, 17 cents compared to a diluted loss per share of 33. Now, non-GAAP operating cash burn for the quarter was $139.4 million compared to $223.9 million. Now, this is what concerns me. Available liquidity at March 31st was $703 million, including $208 million of undrawn capacity under the company's revolving credit facility. Now, guys, that means we finished the quarter with only $495 million in cash, right? Restricted cash of 23.1. Analysts like Avi Harkinshin on Twitter will tell you that, hey, we're at risk. We could lose our revolving debt facility. I don't think so. Not when total revenues grow by over 20% comparing quarter to quarter. Also, Avi will insist we need to raise cash, and we do. Where I push back on the yes voters is the conversion of APE and the dilution that they're talking about and the reverse split. I just can't get behind that because we don't have to pay off all the debt. What AMC needs is a schedule to reduce the debt over a period of time so that we get a healthy debt to equity ratio. Why is that important? Well, to me, it's as important as keeping the stock price over 5. Why is that? Well, a lot of money managers are not allowed to invest in stocks under $5 a share. And don't think that the predatory hedge funds don't know that. They do. Also, when they're screening for companies, they want a healthy debt to equity ratio. They want a healthy long-term debt to equity ratio. And that should be our goal. We should set a goal of what our debt to equity ratio was in 2019 and come up with a time period to pay it down. Now, I am going to continue to argue that paying down that debt within a reasonable time window seems impossible with what we are paying these top executives. Okay? When you look at this statement from 2021, pay rank by title in the media industry, all of these 5 top executives for AMC are earning in the top 5. Now, this is 2021 during a pandemic while we're amassing $5 billion in debt. The week before the compensation committee passed their stock award program, there were like 48,000 deaths due to COVID. Okay, and on top of all that, Hollywood is starving us for product. Even now, we're not getting the same amount of product by the first quarter of 2023 that we did in 2019, and I'll show you the charts to prove it. But I have a real problem with the way we are paying our executives during a crisis. And maybe I can explain it easier using this example. If you own $1 million gas station and you have $5 million in debt and you're paying yourself $1,000 a week or $52,000 a year, would it be reasonable for you to ask for a bonus of $104,000 plus stock and then sell all of your interest in the gas station? Would you be the right person to run the company? Let's talk about our executive vice president, our CFO, Sean Goodman. In 2021, we paid him $785,000, but we also paid him a cash non-stock bonus of more than double that, 1.6 million. And then on top of all that, we awarded Sean $2.3 million in stock. It's actually worse than my gas station example. Now, maybe I could look past all that if Mr. Goodman was buying the stock with us. You know, it's at depressed prices and our CFO is in the trenches with us. But when I go to secform4.com and I look at his buying and selling of our stock over the past 10 years, I learned that he has bought not one single share, but sold $17,752,000 of our stock. Now, guys, stay with me. In the very same year that we paid Mr. Goodman a cash bonus, more than double his salary plus stock, we only had 440 movie releases to present to our customers. In 2019, we had 910. That's only 48% of the product to show. Less than half. So let's revisit my gas station example. What if they only gave us half the amount of gas to sell? And now we're making $52,000 a year, but we're asking for $104,000 a year, and we want stock. Do you see how impossible this is? And while I can respect the opinion of many of the yes voters and Twitter and YouTube personalities like Boss Blunts, Phil For Real, Bigums, even Avi Harkishin, here's the thing. There is more than one way to achieve profitability and reduce your long-term debt other than diluting the company all the way to its eyeballs. For example, let's take another executive, Executive Vice President John McDonald. Now, this is still 2021 in the midst of a pandemic when we're amassing $5 billion in debt, right? And we're basically going through a drought of product from Hollywood. We paid this man $571,000, but we gave him a non-stock cash bonus of $724,000. Then we added another $1,286,000 worth of stock. And this is another executive that in the past 5 years has not bought one share, but sold $8.1 million worth of the stock. You can go through all of the senior executives and see the same pattern. This is indicative of a company trying to bleed the company dry. This is not a company that's behaving like it's trying to recover. The bottom line, guys, is you cannot pay cash bonuses to your executives that exceed their base salaries in a crisis situation and then add a pile of stock to their compensation package, which they immediately dump. Now, while Avi Harkishin will push back and say, hey, we're in risk of losing our revolving debt facility, I would argue that none of this is helping. So how do you calculate the debt to equity ratio? It measures your company's total debt relative to the amount originally invested by the owners and the earnings that have been retained over time. The debt to equity ratio of your business is one of the things the bank looks at to assess your situation before agreeing to lend you an additional amount. And I would only add before it cuts your line of credit. That's from BDC. So how do you calculate your debt to equity ratio? Simple. You divide total liabilities by shareholder equity. So our plan going forward should be to put the company on a schedule to reduce its debt and to stop paying executives bonuses that exceed their base salaries. And then we add a stock bonus that they immediately dump. If we can do something about that, we might actually get out of the hole and post a profit. So, Uncle Frank, keep it simple. What is a good debt to equity ratio? Well, it varies by the industry you're in, but a debt to equity ratio of around 2 to 2.5 is generally considered good. So, where is AMC Entertainment's debt to equity ratio now? Well, as of December 31st, it's negative 1.959, but it is heading in the right direction and is probably improving as we speak now that we have Q1's numbers in. Now remember, the debt to equity ratio measures the long-term debt plus the current portion of long-term debt divided by total shareholders' equity. This metric is useful when analyzing the health of a company's balance sheet. So if we're negative 1.959 as of December 31st, 2022, what were we December 31st of 2019? A positive 3.915. That would be a good target for the company to use. And now you have to come up with a time window, giving yourself time to pay the debt down and have the debt to equity ratio improve. Now, guys, having said all that, I think the quarter we're in is really important to changing our numbers at AMC. The Super Mario Brothers movie is breaking box office records around the world. We also have this coming out, a headline from Deadline, Little Mermaid to do backflips over Memorial Day weekend with a $110 million opening. And guys, for this weekend, get your ass off the couch and go see this movie, Guardians of the Galaxy 3, to end Super Mario's 4-week box office reign with a $120 million debut. And I would only add to the second quarter that with all the swans in the air and the blockbusters coming out, our enemies, the predatory short hedge funds, are beginning to feel the heat. Look at this headline from Reuters. Short selling comes under fire as regional banks sell off. The practice of short selling is coming under increased scrutiny as shares of regional banks remain under pressure, with some calls for more regulatory oversight of the practice. All that can only help our cause. And even though I think the SEC is absolutely worthless, this actually passed from HedgeWeek. Hedge funds face more disclosures as SEC adopts Form PF amendments. Large hedge fund managers will now have to make more disclosures about their investment activities after the SEC yesterday voted to adopt a series of amendments to Form PS, the confidential reporting form for certain SEC-registered investment advisors to private funds. Now, guys, whenever there are problems, trouble, human suffering, you can bet there will also be a predatory short hedge fund there to profit from the misery. But this time they lost. From Bloomberg, short sellers lose $64 million on one regional bank stock bet they made, right? Traders betting against shares of New York-based Community Bancorp have been saddled with roughly $64 million in paper losses this year, according to data from S3 Partners. It's by far the largest mark-to-market loss for U.S. regional bank short sellers and the only unprofitable short position that's greater than $5 million. Now, keep this in mind, though. In contrast, traders who have shorted regional banks are up nearly $7 billion in paper profits so far this year. Guys, this is why sometimes I tell you, root for the white swans too. Okay? They're making a lot of money shorting the bank stocks because they're in trouble. All right? And we've got to remember, good news for regional banks would hurt the short sellers. So be rooting for the white swans as well, like a surprise low inflation number from CPI coming up. Now, even after our strong quarterly results, AMC finished down 0.51% at 5.89. The APE flat at $1.56, bringing the combined price of AMC and APE to $7.45, down 0.4% on 35.6 million shares traded. Now, for next week, based on that closing price of $5.89 on AMC, be looking for support to the downside at levels 566, 544, and 521. To the upside, be looking for resistance at points 611, 634, and 656. Now, this data will likely change before the bell on Monday, but I've got Max Payne at 550, and the put-call ratio is back up to 1.5175. I see 35,409 calls in the money, expired on May 5th, and at the $6 strike, there were 32,523 calls in the money. A disgusting 2.9 million shares suddenly available to borrow at a cost to borrow rate of 177.1%. And I'm going to close this show by saying I don't believe we can beat these people. The prime banks and brokers, no way. The small brokers, the Robinhoods and Weebles of the world, not when they're selling all of their order flow to, corrupt market makers like Citadel and Virtu, not to mention the big hedge funds like Citadel and Susquehanna, and the SEC. I don't think Gary or Hester are going to help us. Obviously, FINRA is not going to help. The DTCC, it's owned by the brokers. They side with the brokers. Limit up, limit down committee, no way. No way. Even within our own boardroom, do I think our company is going to do anything to hurt Wall Street when Wall Street leads our board of directors in the way of Morgan Stanley, and we pay our executives cash bonuses that exceed their base salaries, even though we're going through a crisis, and our executives only dump the stock? No. I really don't think we have a chance. Not while it's allowed, naked and abusive coordinated shorting is allowed. Fail to deliver statistics are ignored. Naked calls, married put strategies are permitted. Hiding the FTDs and in-the-money options is permitted. The misuse of dark pools, the risk of front-running from payment for order flow, labeling your short trades as longs, spoofing and layering, algorithm trading, high-frequency trading, hit pieces in the media. No, I don't really think we can beat these people, but I know who can. White swans and black swans. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.